They called a family meeting on a Tuesday evening in November and voted me out of my own home like a bad investment. My mother sat at the head of the dining table. She had never once cleaned herself, in the house I had paid the mortgage on for 4 consecutive years, and informed me with the specific warmth of a corporate restructuring memo that my room was needed for other purposes. My brother Fletcher stood by the window with his arms crossed, and a smirk he did not bother to conceal. His wife Claudine perched beside him in a cashmere sweater that still had the fold lines from the boutique bag, watching me with the patient curiosity of someone waiting to see how a wounded animal would react to the final blow. My father, seated at the far end of the table with a glass of bourbon he had poured from a bottle I had bought, did not look at me at all. "It is simply a matter of space management, Celeste," my mother said, folding her hands on the table with the practiced composure of a woman who had rehearsed this particular speech. "Fletcher and Claudine need the East Wing for their business operations. The real estate consultancy is expanding, and they require a professional base. Your room and the adjoining study would be perfect for their client meetings. You are 31 years old. It is well past time you found your own place." "I pay the mortgage on this house," I said. "You pay a contribution toward household expenses," my mother corrected smoothly, "as any responsible adult child should." I looked at her for a long moment. "Mum, I wire $4,200 a month directly to the lender. My name is on the co-signed loan agreement. I have the bank statements." Fletcher uncrossed his arms and stepped away from the window, moving to stand behind our mother's chair in a posture of unmistakable alliance. He was 35, 4 years older than me, and he had spent most of those 4 years either between ventures, between apartments, or between excuses. The real estate consultancy was his 6th business in 8 years. The previous 5 had each lasted between 14 months and 2.5 years before quietly dissolving into a collection of unpaid invoices and unanswered creditor calls. "The loan is in Dad's name," Fletcher said. "You are a co-signer, which means you are a secondary party. You have no primary claim to the property. I have been the only person making payments on the property for 48 months. And we are grateful for your contribution," Claudine said, materializing beside her husband with the seamless timing of a woman who had rehearsed her supporting role. Her accent was the particular kind of mid-Atlantic precision that people adopted when they wanted to sound as though they had attended better schools than they had. But family is about more than financial transactions. Fletcher is building something real here. Something that will benefit all of us long term. Surely you can find a nice apartment. You work in finance. You must have savings. I worked in forensic accounting. There is a difference, and it was the kind of difference that was about to matter enormously to every person sitting at that table. But they did not know that yet. They did not know what I did not really. To my family, I was a woman who sat at a computer and looked at numbers which they had collectively decided was a lesser form of intelligence than Fletcher's series of failed entrepreneurial ventures and my mother's decades of managing a social calendar. They did not know that for the past 3 years I had been quietly retained as a specialist consultant for a federal oversight body. They did not know that the project I had been working on for the past 11 months, a forensic reconstruction of a complex multi-entity financial fraud involving a private equity group, 4 shell companies, and a series of falsified audit trails, had reached its conclusion 48 hours ago. They did not know that my fee for that project, the largest single engagement of my career, had cleared my account at 9:17 that morning. They did not know any of it because I had learned early and at significant personal cost that information shared with this family was information weaponized against you. "Fine," I said. My mother blinked. She had expected tears or argument, or the specific brand of quiet pleading she had trained me to produce over 3 decades of emotional management. She had not expected a single syllable of agreement, delivered in a completely neutral register. "I will be out by the weekend," I said. I stood up from the table, picked up my bag, and walked upstairs to my room. "My name is Celeste Vane. I am 31 years old. I am a certified fraud examiner and forensic accountant, And I have spent the past 9 years of my professional life doing one thing with exceptional precision, following the money until it tells me the truth. Money always tells the truth eventually. It is the most honest thing most dishonest people ever produce. You can lie in a deposition. You can lie in a press release. You can lie to your board, your investors, your family, your mirror. But a wire transfer is a wire transfer. A ledger entry is a ledger entry. The numbers do not care about your narrative. They simply sit there, patient and exact, waiting for someone who knows how to read them. I had known since I was 24 years old that my family's financial story did not add up. Not in the large, dramatic way of television fraudsters, but in the quiet, persistent way of people who have been borrowing against a future that does not exist. My father, Edward Vane, had spent his career as a mid-level commercial insurance broker, a profession that had provided a comfortable upper-middle-class life in the years when he was actually practicing it. He had stopped practicing it in any meaningful sense approximately 6 years ago, when the combination of 2 consecutive bad quarters, a significant gambling problem he described to family members as bad luck at the track, and the dissolution of his primary business partnership had left him operating a diminished version of his former firm from a home office with 2 remaining clients and a reputation that had quietly corroded to near worthlessness. My mother Diane knew about none of this. Or rather, she knew about all of it and had chosen to organize her understanding of the family's financial situation around the word temporary, which she applied to every crisis with the dedication of a woman whose entire identity depended on the appearance of stability. Fletcher knew about his father's problems because Fletcher had the same problems. He was constitutionally incapable of the patience required to build anything durable, and he had spent his adult life moving quickly from opportunity to opportunity, each one described to the family in the language of imminent success, each one concluding in the language of external blame. The market shifted. The partner let him down. The timing was wrong. The investors lacked vision. Claudine knew about all of it because Claudine was beneath the cashmere and the cultivated accent and the performance of tasteful wealth, a remarkably intelligent woman who had made a calculated decision to attach herself to a family she believed had more assets than debts. She had been performing that calculation for 3 years and had not yet realized how badly she had miscalculated. I had been watching all of this with the professional detachment of someone who audits for a living. I had documented it quietly, not out of any plan for revenge, but because documentation is simply what I do. It is as automatic as breathing. I see a financial pattern and I record it. I see a discrepancy and I note it. I see a structure that does not withstand scrutiny, and I build a parallel record of what the scrutiny would reveal. I had 3 years of parallel records. On the evening they voted me out of my own home, those records became relevant in ways they had not anticipated. I spent Wednesday and Thursday quietly arranging my exit. I called my colleague and closest professional friend, a tax attorney named Raymond who operated a boutique practice in Midtown and who had referred me to the federal oversight engagement that had just concluded. I told him what had happened in the most neutral terms I could manage, which were fairly neutral because I had processed the emotional component of this particular betrayal some years before its formal enactment. Raymond listened without interrupting, which was one of the things I valued most about him. When I finished, he was quiet for a moment. "The co-sign situation," he said. "How is it structured?" "I am listed as co-borrower on the primary mortgage. 48 months of payments, all from my account, all documented. The property deed lists my father as sole owner, which was the arrangement when he originally purchased the home 12 years ago. The refinancing 3 years ago, when he could no longer service the loan independently, was when my name was added to the note. And your brother's awareness of this structure. He cited it at the table. He knows I am a secondary party on the loan." "He is relying on the distinction between the deed and the note," Raymond said. "Legally, he is not wrong about the primary claim, but that is not the only angle." "No," I agreed. "It is not." Raymond was quiet again for a moment. What exactly did your project conclude? I cannot discuss the specifics, I said, but the fee cleared Monday morning. Another pause. How much? I told him. Raymond made a sound that was not quite a word. Then, Celeste, what are you planning to do? Nothing dramatic, I said. I am going to move into the Langham for the rest of the month, while I find a permanent place. I am going to spend the weekend doing what I do when I have a complex financial situation in front of me. I am going to read the documents. Which documents? All of them, I said. The Langham Chicago occupied a building on the Chicago River that had been designed with the specific intention of making the people inside it feel as though the ordinary frustrations of the world operated at a significant remove. I checked in on Friday afternoon, took a suite on the 14th floor with north-facing windows that turned the river into a moving stripe of silver in the November light, ordered dinner from room service and opened my laptop. I had been maintaining a financial file on my family for 3 years. Not comprehensively, I was not conducting a professional engagement, and I had not had access to their internal accounts. But I had been maintaining a parallel record of observable data. Public filings, property records, court documents, business registrations, credit inquiry, patterns visible through shared accounts, and the specific financial behaviours that members of a family reveal to each other, without meaning to, in the form of offhand comments, borrowed items, and the particular quality of silence that surrounds money that is not there. I had a forensic accountant's understanding of what the observable data suggested was happening beneath the surface of the Vane family's financial life. I had never had the specific numbers to confirm the hypothesis. That was about to change. I opened a secured browser and began where I always begin with the public record. The Illinois Secretary of State's business database is publicly searchable. Fletcher's current venture, the real estate consultancy he had described at the dinner table as expanding, was registered as Vane Property Group, LLC. The registration date was 14 months ago. The registered agent was Fletcher himself. The most recent annual report filed 3 months ago listed total assets of $42,000 and a single employee. One employee. His wife was presumably performing labour for the company without appearing on the payroll, which was a record-keeping choice that had its own implications. I searched the previous 5 entities Fletcher had operated. 3 of them had been administratively dissolved for failure to file required reports. One had an outstanding judgment of $18,000 from a former business partner who had sued successfully for breach of contract and had apparently been unable to collect because by the time the judgment was entered, the company's bank accounts had been emptied and closed. The 5th had filed for Chapter 7 bankruptcy protection 22 months ago, listing liabilities of approximately $340,000 against assets of $11,000. $340,000. I sat back in my chair and looked at that number for a moment. The creditors listed in the bankruptcy filing included 2 private investors who had contributed seed capital, a commercial landlord owed 6 months of back rent, a marketing firm, a technology contractor, and 3 individual suppliers. None of them had recovered anything meaningful. The Chapter 7 trustee had closed the case with a distribution of less than 3 cents on the dollar. I noted all of this in my working file and moved to the property records. My father's house, the house I had been paying the mortgage on for 4 years, was a 4-bedroom colonial in Evanston, valued by the county assessor at approximately $1.1 million. The current mortgage balance, which I could calculate from the original loan amount and the payment history, was approximately $640,000. There was also a home equity line of credit. I could see from the original filing that it had been opened 2 years ago with a maximum draw of $200,000. I did not know the current balance on the equity line, but I knew that my father had in the same 2-year period, during which the equity line had been opened, replaced his car twice, taken 3 separate international trips that he described to family members as business travel, and installed a complete renovation of the kitchen and master bathroom that he had attributed to a contractor discount through a friend. People who have money do not need equity lines for kitchen renovations. People who are servicing an equity line do not typically have money available for other things. I made a note, flagged it, and moved on. The next search was the one I had been avoiding for 3 years, not because I was afraid of what I would find, but because finding it would transform a hypothesis I could live with into a documented fact I would have to act on. I searched my father's name in the Illinois court records system. The results loaded in 4 seconds. There were 7 entries. 2 traffic violations dismissed, 1 small claims action from 8 years ago settled, and 4 civil filings in the past 3 years, all from creditors: a credit card company, a private lender, a business services firm, and most recently, 6 months ago, a judgment entered by a company I recognized immediately as a subsidiary of a predatory short-term lending operation that targeted small business owners and individuals with damaged credit histories. The judgment amount was $94,000. I looked at that number for a long time. $94,000 entered as a judgment 6 months ago, meaning the underlying debt was older and the creditor had exhausted other collection attempts before pursuing litigation. This was not a new problem. This was a problem that had been developing for years while my family sat at that dining table in the house I was paying for, and drank the bourbon I was indirectly funding and looked at me with the comfortable condescension of people who believed they occupied a higher stratum of competence than the daughter who sat at a computer and looked at numbers. I closed the court records tab and opened a new one. I had one more search to conduct, and this one required a tool that most people did not have access to. As a licensed forensic accountant with an active federal consulting relationship, I maintained access to a commercial credit and business intelligence database that aggregated public filings, lien records, UCC filings, and bankruptcy data across all 50 states. I ran my father's name and social security number through the system. The report generated in 11 seconds. I read it twice. Then I set my laptop on the coffee table, walked to the window, and looked at the river for a long time. My father owed across various creditors a combined total of approximately $412,000. The debts ranged from the $94,000 judgment I had already found to a series of smaller balances on credit accounts, 2 personal loans, and a deferred payment arrangement with the IRS for back taxes from 3 years ago that he had apparently been servicing inconsistently. The home equity line had a current draw balance of $178,000, which meant that the equity in the property I had been paying the mortgage on the property that my brother had just informed me I had no primary claim to, was approximately $280,000. Less once transaction costs were factored. My brother had evicted me from a house that was functionally underwater in the name of a man who was $400,000 in debt to make room for a real estate consultancy with $42,000 in total assets. I returned to the table, picked up my room service glass, and took a slow sip of water. I was not angry. Anger is an emotion that produces noise without producing results, and I had learned to convert it into something more useful. What I felt standing in that hotel room with the full shape of my family's financial reality, visible for the first time in its complete dimensions, was the specific clarity that comes to a forensic accountant when the picture that has been obscured by missing documents finally assembles itself. I could see the whole picture now. And the picture had a very specific set of implications. I picked up my phone and called Raymond. "I have read the documents," I said when he answered. "And?" I told him what I had found. All of it. The judgments, the equity line, the bankruptcy history, the IRS arrangement. I read him the numbers in sequence the way I would present them in a client briefing without editorial comment. Raymond was quiet for a full 30 seconds after I finished. "Celeste," he said, "I need you to tell me something honestly." "All right. When you moved into that house 4 years ago and started making mortgage payments, did you document the arrangement?" "I documented everything," I said. "Wire transfer records from my account to the lender monthly, 48 consecutive months. Emails from my father acknowledging the arrangement, 3 of them from the first year. A text thread from 8 months ago in which my mother refers to my monthly payment in writing, and a one-page written agreement that my father signed when the refinancing was done, acknowledging my contribution and describing the arrangement as a financial partnership towards shared equity. Raymond made a sound that was somewhere between a laugh and an exhale. You had a signed agreement. I am a forensic accountant, I said. I document things. Does your brother know about the signed agreement? He knows I am on the loan. He does not know about the signed document. Which means his calculation at the dinner table was based on incomplete information. Yes, I said. Most people's calculations are. There was a brief pause. What do you want to do? Raymond asked. I looked out at the river. The November light was almost gone now, the water dark between its lit banks. I want to do exactly what I do at work, I said. I want to follow the money. All of it. Every dollar my family has spent that they did not have, every debt they have incurred, every financial structure they have built on a foundation that does not exist. I want to document it completely. And then I want to make sure that the people who told me I was contributing to a household and was welcome to stay until I was no longer convenient understand the full scope of what that contribution has actually been financing. That is not dramatic, Raymond said. There was something in his voice I recognized as approval. No, I said. It is arithmetic. I spent the weekend reading. Not just my family's finances, though those occupied the majority of my attention. I also spent time reading the specific legal framework around co-borrower rights in Illinois mortgage agreements, the provisions of the written document my father had signed at the refinancing, and the statutory framework around fraudulent conveyance, and unjust enrichment in the context of undisclosed family financial arrangements. I was not planning to sue my family. Litigation is expensive, slow, and emotionally consuming, and I had neither the patience nor the inclination for a prolonged legal war with people I am months. I was already in the process of removing from my life. What I was doing was building an understanding of the complete terrain before deciding where to walk. On Sunday afternoon, Raymond called me. I have been thinking about the equity line, he said without preamble. So have I. $178,000 drawn against the property in the past 2 years. Your mortgage payments have been the only consistent service on the underlying note during the same period, meaning without your contribution, the primary mortgage would likely be in default. Which means the equity line was extended by the lender in part because the primary note was current. Meaning my payments made the equity line possible, I said. Meaning your payments made the equity line possible, which your father then drew down by $178,000 for purposes you did not authorize and of which you were presumably unaware. Correct. Celeste, Raymond said carefully. That is a constructive fraud argument. It is not clean and it would require litigation to establish, but the underlying logic is defensible. I know, I said, but I am not planning to litigate. Then what are you planning? I am planning to have a conversation, I said. With complete information. Those are the only conversations worth having. I did not contact my family for the first 2 weeks after the dinner table meeting. They contacted me. My mother called 4 times in the first week, leaving messages that ranged from logistical to guilt-inflected, to by the 4th call something closer, to anxious. She wanted to know when I was planning to collect the rest of my belongings. She wanted to know if I was comfortable. She wanted me to know that they had been thinking about me and that the family cared about my well-being. She did not mention the mortgage. She did not mention the 4 years of payments. She did not ask whether I needed anything. Fletcher sent a single text on the Thursday of the first week. It said, "Moving company will be there Saturday to set up the office. Wanted to give you heads up in case you had things to collect." I did not respond. I found a permanent apartment during the 2nd week. It was in the West Loop, a 2-bedroom in a building with a concierge and a gym that I had no intention of using. It was considerably more expensive than what my contribution to the family mortgage had been. But I was for the first time in 4 years spending money on something that was entirely mine. The lease was in my name alone. The keys were mine alone. Nobody would be calling a family meeting to vote me out of it. I spent the second week also working on something else, something that had been developing at the periphery of my awareness for months, and that I had been quietly researching in the evenings after the federal project wrapped. The real estate consultancy, Vane Property Group LLC. I had looked at the surface data on the night I arrived at the Langham, the registration, the asset statement, the employee count. But the surface was not where the interesting information lived. The interesting information lived in the details that required more time and more specific tools to find. I found the first interesting detail on a Tuesday evening 3 weeks after the dinner table meeting. Fletcher's real estate consultancy listed as its primary activity the arrangement of off-market commercial property transactions for institutional clients. This was a business model that existed and was legitimate, but it required the consultant to have established relationships with institutional buyers, proprietary deal flow, and a demonstrable track record. Fletcher had none of these things in any verifiable form. What he did have, I discovered when I traced the business registration back through its paperwork chain, was a co-registration relationship with an entity called Meridian Capital Advisors, LLC. Meridian Capital Advisors was not Fletcher's company. It was registered to a man named Philip Sorrell, whose name I did not recognize, but whose business history I spent 40 minutes examining with considerable interest. Philip Sorrell had been a registered investment advisor until 3 years ago, when his registration had been revoked by the Financial Industry Regulatory Authority following a disciplinary proceeding. The proceeding, which was a matter of public record, found that Sorrell had engaged in unsuitable investment recommendations that had resulted in client losses of approximately $2.2 million. Sorrell was barred from working in any registered capacity in the securities industry. But he was not barred from operating an unregistered LLC, and he was not barred from entering into business arrangements with other people's LLCs. And he was apparently not barred from whatever arrangement he had with my brother, which was not disclosed in any public filing I could find, but which was implied by the fact that Vane Property Group, LLC, and Meridian Capital Advisors, LLC, shared the same registered address, a mailbox service in the Loop, and had filed a joint notice of business relationship with the Illinois Secretary of State 4 months ago. I documented all of this in my working file and flagged it. Then I made a phone call to a contact of mine at the SEC's Chicago regional office. I did not file a complaint. I did not allege fraud. I simply had a professional conversation with an examiner I had worked with on a previous matter and mentioned in the most technically neutral language available to me that I had observed a business registration pattern that might be of interest to her office's ongoing monitoring activities. I described the structure. I described Sorrell's regulatory history. I mentioned the joint filing. My contact was quiet for a moment. "Is this coming from a professional context or a personal one?" she asked. "Both," I said. "I want to be transparent about that." "I appreciate the transparency," she said. "I will make a note and route it to the appropriate team." "That is all I am asking," I said. I ended the call and added the contact report to my working file. The call that changed everything came on a Thursday morning 4 weeks after the dinner table meeting. I was at my desk in my new apartment reviewing a client workbook when my phone rang with my mother's number. I considered letting it go to voicemail. Then I answered. "Celeste." Her voice was different from the messages she had been leaving. The managed composure was still there, but beneath it was something tighter and more urgent. "I need to talk to you. Can you come to the house this weekend?" "I can make time Saturday morning," I said. "What is this about?" There is a situation with your father's finances. Fletcher has been helping him manage some things, and there has been a complication. We would like you to look at some documents." A complication. I noted the word choice. In my professional experience, the word complication was almost always doing the work of a significantly larger word that the speaker was not prepared to say out loud. "What kind of documents?" I asked. "Legal correspondence? From a bank? Fletcher says it is routine, but it does not look routine to me, and your father is not. He is not explaining things clearly." She paused. "You understand these things, Celeste. You always have. We thought perhaps you could help us understand what we are looking at." I looked at the ceiling for a moment. You understand these things. After 31 years of being told that sitting at a computer looking at numbers was not real work, that my profession was lesser than Fletcher's series of financial disasters, that my contribution to the household was a function of my status as a responsible adult child, rather than a demonstration of capability, after all of that, the word complication had arrived to rearrange the hierarchy. "I will be there Saturday at 10, I said. I ended the call and sat quietly for a moment. Then I opened my working file and began preparing for the meeting. The house in Evanston looked exactly as it always had from the outside: the colonial facade, the mature oak tree in the front yard that shed leaves across the porch every November, the brass knocker on the front door that my mother polished on a rotating schedule. Nothing about the exterior suggested that the interior was occupied by people who had spent 4 years living on borrowed time and one daughter's mortgage payments. I arrived at 9:55 with a leather portfolio that contained a printed copy of my complete working file, organized by subject and date with a cover index and tabbed sections. I had prepared it with the same care I brought to a client deliverable, because in every meaningful sense, that was exactly what it was. My mother answered the door. She was dressed as she always dressed on weekend mornings: pressed blouse, tailored trousers, the gold earrings she wore to project normalcy. But she looked tired in a way that makeup could not fully address, and her eyes carried the specific quality of a person who has been not sleeping because they are doing mathematics in the dark. "You look well," she said, which was what she said when she was not prepared to say what she was actually thinking. "I am well," I said. "Where is everyone?" "Your father is in the living room. Fletcher and Claudine are on their way. They should be here shortly." She stepped back to let me in. I walked through the entrance hall, noting that the renovation she and my father had described as a kitchen update had extended into a full replacement of the hardwood floors in the main corridor. New floors, new kitchen, new bathrooms, on $178,000 of equity line money. In the living room, my father was sitting in his usual chair by the fireplace. He was wearing the expression I had seen on him only a handful of times in my life, not the bluster, not the confident patriarch performance, but something more fundamental and more frightened. He looked like a man who had finally been asked to produce the evidence for claims he had been making for years and had discovered that the evidence did not exist. "Celeste," he said. "Dad," I said. I sat in the chair across from him. My mother sat on the sofa between us. Nobody spoke for a moment. "Mum said there is correspondence from a bank," I said. My father reached to the side table and picked up a manila envelope. He held it for a moment before handing it to me. His hand, I noticed, was not entirely steady. I opened the envelope and removed the contents. It was a formal notice from a commercial lending institution addressed to my father. I read the first paragraph and understood immediately what I was looking at. The home equity line of credit had been identified as in a distressed status. The bank was issuing a formal demand for the outstanding balance of $178,000, citing a triggering provision in the original line agreement related to the borrower's overall creditworthiness. The provision, which I recognized as standard in equity line agreements, allowed the lender to call the full balance due in the event that a significant adverse change in the borrower's financial status was documented. The adverse change, per the letter, was the $94,000 judgment entered 6 months ago against my father in favor of the predatory lending subsidiary. The judgment had been reported to the major credit bureaus. The equity line lender had run a credit review as part of their standard annual monitoring and had discovered it. They were now calling the balance $178,000, due within 60 days. I set the letter down on the coffee table and looked at my father. "How much of the equity line proceeds have you spent?" I asked. He was quiet for a moment. "Most of it." "What does most mean in specific dollar terms?" "All of it," my mother said quietly from the sofa. Her voice was very flat. She had, I realized, known the answer before asking the question. "He spent all of it." My father did not deny it. "On what?" I asked. "Various things." My father said, which was the answer of a man who did not want to account for specific line items because the specific line items would be worse than the aggregate. I thought about the car, the international trips, the kitchen renovation, the bathroom renovation, the new floors in the hallway. The country club dues that I knew my parents continued to pay despite every visible indicator that they could not afford them because the country club membership was a signal of belonging to a world that was increasingly theoretical. There is also the judgment, I said, $94,000. I assume you are not in a position to satisfy that independently. He shook his head. And the primary mortgage, I said, which is current because I have been making the payments. If I stop making the payments, how long before it goes into default? My father looked at me. My mother looked at my father. The silence in the room was the specific silence of people who have avoided a conversation so completely that when it finally arrives, they have no language for it. 2 months, my father said. Maybe 3. I nodded slowly, absorbing the arithmetic. The door opened. Fletcher and Claudine arrived, bringing with them the particular energy of people who had been talking in the car on the way over and had arrived at some coordinated position. Fletcher was wearing a blazer over a weekend shirt, the startup founder casual that he deployed for occasions requiring both authority and approachability. Claudine was in the cashmere sweater again. She had removed the fold lines this time. Celeste, Fletcher said, with the managed warmth of a man addressing a colleague he found inconvenient. Good to see you. Sit down, Fletcher, I said. He blinked. The warmth receded slightly. He sat taking the sofa cushion beside my mother. Claudine perched beside him. I have spent the past 4 weeks reviewing the family's financial situation, I said, opening my portfolio on the coffee table. I want to walk everyone through what I found. Celeste, we did not ask you here to audit us, Fletcher said with a laugh that was designed to sound easy but landed as defensive. We just need help with Dad's bank letter. I know what you asked me here for, I said, and I will address the bank letter. But first we are going to establish some context because this conversation has needed to happen for a long time and the bank letter has created a moment where everyone is present and motivated to listen. I placed the first tabbed section of the file on the coffee table and turned it so they could read the top page. This is a summary of the household's financial position, I said. I will go through it in sections. Please hold questions until I have completed the overview. My mother looked at the page, then she looked at me. Something shifted in her expression that I had not seen there before. Not guilt, not quite, but the precursor to guilt. The specific expression of someone who has just realized that the daughter they scheduled for removal has been paying very careful attention. I began. The overview took 40 minutes. I had structured it the way I structured client presentations, chronological factual, with no editorializing. I did not use words like irresponsible or reckless. I used words like undisclosed and unserviced and misallocated. I let the numbers do what numbers do, which is exist without sentiment and resist reinterpretation. I walked them through the mortgage history. 48 months of payments from my account totaling $216,000 in principal and interest. I showed them the wire transfer records which I had printed in a clean table format with dates, amounts, and confirmation numbers. I walked them through the equity line, the original draw, the allocation as best I could reconstruct it from the available evidence and the current demand balance of $178,000. I walked them through the judgment, the underlying debt, the creditor, the amounts, the timeline. I walked them through the IRS arrangement, which my father had apparently not mentioned to my mother, whose expression upon seeing that section of the file became very still in the way that faces become still when they are working very hard not to react visibly. I walked them through Fletcher's business history, the 5 previous entities, the Chapter 7, the unrealized judgment, the current consultancy's assets, and then I placed the last tab on the table, which contained the Philip Sorrell section. Fletcher's eyes went to that page and stayed there. Vane Property Group has filed a joint notice of business relationship with an entity whose registered agent is a formally licensed investment advisor who was barred from the securities industry 3 years ago for causing client losses of $2.2 million. I said. That joint filing creates a potential association liability for you personally if the barred individual is conducting activities through your entity that fall within the scope of the securities regulations from which he is excluded. Claudine, who had been maintaining a practiced composure throughout the presentation, turned to look at Fletcher with an expression I recognized from years of watching people process information that they had not been given access to before. "What does that mean?" Claudine said. The question was directed at Fletcher, but delivered in the register of someone addressing a question to the room. "It means the SEC may have a conversation with your husband in the near future," I said pleasantly. "Whether that conversation is routine or substantive will depend on what that conversation finds." Fletcher looked at me. His jaw was working slightly the way jaws work when the person behind them is calculating how much has been revealed and what it implies about how much more might be known. "You filed a complaint," he said. "I had a professional conversation with a contact at the regional office," I said. "I disclosed my personal relationship to the subject and let her determine whether it warranted further attention. That is standard procedure." "You reported your own brother to the SEC." Claudine said, her accent becoming slightly more pronounced, which was in my experience what it did under pressure. "I reported a regulatory concern to the appropriate authority," I said, "which is also what I do at work." My mother was looking at the table. My father had not spoken since I began the presentation. He was looking at his hands, which were folded in his lap with the careful stillness of a man who has run out of performances to give. "So," Fletcher stood up from the sofa, pulling his blazer straight in a gesture of reasserting authority. "Great. You have done a lot of research. What exactly is the point of all this, Celeste? You want us to apologize for asking you to find your own place. You want money. What do you want?" I looked at him. "I want you to understand the complete picture," I said, "because you made your decision at that dinner table based on an incomplete picture. You thought you were evicting a secondary party from a property with clear equity and a stable financial base. You are actually standing in a property with approximately $280,000 of net equity that is now subject to a $178,000 demand from the equity line lender, plus a $94,000 judgment against the primary owner, plus a deferred IRS arrangement of unknown current status, plus a primary mortgage that is current only because of my monthly contributions." Fletcher stared at me. "If I stop making mortgage payments," I said, "the primary note goes into default within 60 to 90 days. When that happens, the equity line lender, who has already issued a demand, will accelerate their position. The combined outstanding obligations against the property will exceed the available equity. The house will be underwater." Claudine had stopped looking at Fletcher and was now looking at me. "You are saying you are going to stop paying the mortgage," she said slowly. "I am saying that I have been paying the mortgage on a property I was asked to vacate," I said. "I am presenting the financial context so that everyone in this room can make informed decisions about what happens next. I am not going to make those decisions for you, but I am going to stop subsidizing outcomes I had no voice in determining." My father finally looked up from his hands. "Celeste," he said. His voice was very quiet. "What do you need from us?" It was the first time in my adult life that my father had asked me that question. I looked at him for a long moment, not with anger and not with pity either, but with the specific patience of a forensic accountant looking at a document that contains both the problem and the solution if you know where to read. "I need 3 things," I said. "First, I need the signed equity agreement from the refinancing to be formally registered with the county recorder as a lien against the property, acknowledging my financial contribution and establishing my secured interest. Second, I need the family's acknowledgement in writing that the narrative about my contribution being a household expense was inaccurate and that my payments constitute an equity interest in the property. Third, I need a family meeting, a real one, with full financial disclosure on the table to determine what the realistic path forward looks like for this household. Or, Fletcher said. The word was flat and aggressive, but there was something under the aggression that I recognized as fear. There is no or, I said. I am not making threats. I am describing the situation accurately and proposing a path forward that protects everyone's interests, including yours. If the house goes into default, Fletcher, there is no office, no client meetings, no consultancy base. You lose the address that currently gives Vane Property Group a veneer of residential legitimacy. Claudine reached out and put a hand on Fletcher's arm. It was the same gesture she had used at the dinner table, the practiced peacemaker. But the calculation behind it was different now. She was not managing him on behalf of the family's position. She was managing him on behalf of her own. Fletcher looked at his wife. Then he looked at me. "Give me the weekend," he said. "You have until Monday morning," I said. I closed my portfolio, picked it up from the coffee table and stood. "I will be at my apartment. You have my number." I walked to the front door. My mother followed me. In the entrance hall, with the new floors under our feet and the brass knocker gleaming on the door ahead of me, she put her hand on my arm. "Celeste," she said. I turned. "I did not know about most of it," she said. "The judgment, the IRS. I knew things were difficult, but I did not know the extent." I looked at her. She was telling the truth, or close enough to it that the distinction did not matter for the purposes of this conversation. "I know," I said. "That is part of the problem." I opened the front door and walked out into the November air. The weekend produced 3 phone calls and 1 text message. Fletcher called Saturday afternoon and attempted in the measured tones of a man performing reasonableness to suggest that my registration of the lien was unnecessarily aggressive and that a simpler arrangement could be discussed. I told him that registering a lien on a debt of $216,000 was not aggressive. It was elementary. He said he needed more time. I told him he had until Monday. Claudine called Saturday evening, which surprised me. She did not speak for a moment after I answered, which told me she had rehearsed an opening line and then decided against it. "I did not know about the Sorrel situation," she said finally. "I believe you," I said. "How serious is it, the SEC contact you mentioned?" "I do not know," I said, which was true. "It depends on what the examination finds. If the relationship with Sorrel is entirely administrative, shared address, nothing more, it may not develop into anything. If there is substantive involvement, the exposure is more significant." She was quiet. "His previous business, the one that went bankrupt." "I have the public filings," I said. "How much did his investors actually lose?" $340,000. That was the total liability in the Chapter 7 filing. But I did not know how much Claudine knew about her own finances, and I was not going to be the person who delivered information about her husband's past to her without knowing what she was equipped to do with it. The public record shows liabilities of approximately $340,000 against assets of $11,000, I said carefully. The distribution to creditors was less than 3 cents on the dollar. Another silence. "He told me the business failed because the market shifted," she said. "That is a possible contributing factor," I said. "But it is not the whole story." "Based on the public filings, I do not believe it is the whole story," I said. "But I am not in a position to tell you what the rest of the story is. You would need to ask him directly." She ended the call without saying goodbye, which was not rude in context. It was simply the behavior of a woman who had just received information and needed to go somewhere quiet to process it. My father sent the text message on Sunday morning. It said, "I have spoken to a solicitor. I am prepared to do what is right. Thank you for coming on Saturday." On Monday morning, Raymond called me before I had finished my first cup of coffee. "I have just received a call from the county recorder's office," he said. "Your father's attorney filed the lien registration this morning. It is officially recorded." I set down my cup. "All 3 conditions," Raymond said. "The lien, the written acknowledgement of equity interest, and a request for a formal financial disclosure meeting. His attorney sent the request to my office this morning. He is asking for a 2-week window to prepare full documentation. That is reasonable, I said. Celeste, Raymond said, what exactly did you say to them on Saturday? The truth, I said, completely and in detail. Raymond was quiet for a moment. You know what this means in terms of the equity position? I know what it means, I said. If the house is ultimately sold or refinanced to satisfy the equity line demand, and the judgment your secured interest in the property now entitles you to a priority distribution from the proceeds. I know, I said, which means that after the lender is satisfied, your $216,000 contribution comes back to you before anyone else receives anything. I know, I said, which means Fletcher and Claudine's plan to use the house as a base for their consultancy is no longer viable in any scenario where the house needs to be sold. I know, I said. There was a pause. You are remarkably calm about all of this, Raymond said. I have been doing the math for 4 years, I said. The calculation is not new. I am just the first person in that house who wrote it down. The financial disclosure meeting was scheduled for a Saturday, 2 weeks after my father's attorney filed the lien registration. In those 2 weeks, 3 things happened that I had anticipated. One thing happened that I had partially anticipated, and one thing happened that I had not anticipated at all. The first anticipated thing was that Fletcher attempted to retain his own forensic accountant to challenge my working file. I knew this because Raymond received a records request from a firm I recognized as a mid-tier downtown practice that did occasional litigation support work. The request was for documentation of my professional credentials and the methodology of my financial reconstruction. It was a standard discovery-style probe, the kind a defensive party deploys when they want to understand what they are walking into. I authorized Raymond to provide my full professional history, my certifications, and a detailed methodology note. I had nothing to conceal about how I had reached my conclusions, and transparency in this context was itself a form of pressure. A person who opens their entire methodology to scrutiny is a person who is confident the scrutiny will not find anything. The second anticipated thing was that Claudine began asking questions. Not to me, not directly, not yet, but to Diane, which I learnt from my mother's increasingly strained phone calls during the second week. My mother was calling me more frequently now, and the calls had shifted in register from the managed composure of the first weeks to something more raw and more honest, which I attributed to the fact that the financial picture I had presented in the Evanston living room had apparently not been fully absorbed in a single Saturday morning and was continuing to metabolize through the household at varying rates in the days that followed. Claudine has been asking your father about the bankruptcy, my mother said on the Wednesday of the second week, the one before the last one. Which specific aspect? I asked. The investors. She wants to know if any of them are, she used the word, actionable. My mother's voice carried the specific bewilderment of someone encountering a word in a context that does not match their mental model of who uses that word. Claudine is asking whether Fletcher's former investors have viable claims against him personally, I said. Is that what that means? Yes, my mother was quiet for a moment. Should they? I do not know the internal details of that entity, I said. The public record shows a Chapter 7 with significant investor losses. Whether personal liability attached depends on how the corporate formalities were maintained and whether any of the losses resulted from actions that pierced the corporate veil. I would need to review the actual case file to have an informed opinion. Celeste, my mother said. In plain language. In plain language, shall, I said. It depends on whether Fletcher ran that company honestly, and if he did not, it depends on whether the investors or the bankruptcy trustee were motivated enough to pursue him personally. The public record suggests the trustee was not. That does not mean a private action is impossible. My mother did not say anything for a moment. Then, how do you know all of this? I study it, I said. It is what I do. I know it is what you do, she said, and something in her voice shifted slightly in the way that voices shift when the speaker is reaching the edge of a long-maintained position. I suppose I never fully understood what that meant. I did not respond to that directly. It was true, and it was also not the conversation we needed to have at that moment. The third anticipated thing was that my father's IRS arrangement became more complicated. The deferred payment plan he had been servicing inconsistently had, as I had suspected when I flagged it, in my working file accumulated penalties during the periods of inconsistency. The IRS had sent a revised notice during the first week, which my father's attorney forwarded to Raymond, which Raymond forwarded to me. The revised amount owed, including accumulated penalties, was $61,000. Not dramatically different from what I had estimated, but materially worse than the original arrangement, and one more obligation stacked against a house that was increasingly resembling a financial structure that existed primarily in the imagination. The partially anticipated thing was Fletcher's reaction to the SEC contact. I had expected him to be angry about it. I had expected him to deploy anger strategically the way he had deployed it my entire life, as a tool for making other people feel responsible for his circumstances. What I had not fully anticipated was the specific form his anger took, which was directed not at me but at Philip Surreal. I learned this from Raymond, who received a call from a mutual contact in the regulatory space during the second week. The SEC's regional office had reached out to both Fletcher and Sorrell as part of a preliminary inquiry. Sorrell, who had apparently anticipated this possibility and had his own legal counsel prepared, had responded promptly and cooperatively. Fletcher, who had not anticipated it and had no legal counsel prepared, had called Sorrell directly before engaging an attorney, which was precisely the kind of instinctive reactive decision that creates additional problems. The call had not gone well. Sorrell, understanding that cooperation with regulators was his only viable path given his existing bar, had told Fletcher in clear terms that he intended to provide a full and accurate account of their business relationship to the examiner. Fletcher, who had apparently believed their arrangement was more informal and therefore less documentable than it was, had responded in a way that Sorrell had described to his own attorney as threatening. The threat, whatever form it took, had now been relayed to the SEC examiner as part of Sorrell's cooperation. Fletcher had managed to transform a preliminary inquiry into a more serious examination in the span of a single phone call. This was, in my professional experience, not unusual. People who have spent their lives relying on social manipulation and interpersonal pressure as their primary tools tend to deploy those tools reflexively, even when the situation demands something different. The instinct to intimidate does not turn off simply because the target is a federal regulator. I documented the development in my working file and said nothing about it to anyone in my family. The unanticipated thing was Claudine. On the Friday evening before the disclosure meeting, my phone rang with her number. I answered with the same neutral professional manner I had used for every interaction in the past month. "I want to talk to you before tomorrow," she said without preamble. "Separately, not with the family." "All right," I said. "I am going to ask you something, and I need you to tell me the truth, not the diplomatic version, the actual truth." "I do not have a diplomatic version," I said. "I have the documented version, which is the truth, and I have versions that omit certain details when the details are not yet confirmed. Ask me what you want to know." There was a pause. I could hear her breathing the specific quality of someone composing themselves before a difficult question. "The bankruptcy," she said. "The $340,000? Was it fraud?" I did not answer immediately. Not because I was deciding whether to answer, but because the honest answer required precision. "Based on the public record alone, I cannot determine intent," I said. "The Chapter 7 filing reflects a company that was insolvent at the time of filing and that had taken on significantly more investor capital than could be justified by its actual asset base. Whether that was the result of fraudulent misrepresentation to investors' operational incompetence, or some combination of both, is something that the public record does not definitively answer." "But you have an opinion," she said. "I have a hypothesis," I said, "which is different." "Tell me your hypothesis." I thought about this for a moment. Claudine was technically adverse to my interests in this family negotiation. She was also, I had come to believe, a person who had been operating with incomplete information and who was now trying to construct an accurate picture in real time. My hypothesis, I said carefully, is that the pattern across multiple business failures, the rapid escalation of investor commitments relative to actual business development, the timing of asset dissipation relative to insolvency, the decision to file Chapter 7 rather than Chapter 11, which would have required a reorganization plan subject to creditor oversight, is consistent with a pattern of behavior designed to maximize personal benefit from investor capital before the inevitable failure of the business became undeniable. Claudine was very quiet. In plain language, I said, because my mother had asked for it, and it had been useful. My hypothesis is that the investor's money was spent on things that were not the business. Things like what? She said. Her voice was very flat. The bankruptcy filing was 3 years ago, I said. 3 years ago, Fletcher leased his current car. He and you took a trip to the Maldives. Your apartment was upgraded from the 1-bedroom in Wicker Park to the 2-bedroom in River North. I am not alleging fraud. I am describing an observable timeline. The silence lasted long enough that I considered whether she had ended the call. He told me the Maldives trip was from a business account that had been distributed as earned compensation, she said. That is possible, I said. It is also the kind of characterization that is easy to make and difficult to verify without access to the internal accounts. And the investors, she said, the ones who did not recover anything. 3 of them filed the original civil suit before the bankruptcy. The suit was stayed when the Chapter 7 was filed. After the case closed with minimal distribution, one of them pursued a personal judgment against Fletcher individually. The judgment was entered, but the collection attempt was unsuccessful because by that point the personal assets were structured in a way that made collection difficult. Structured how? The car is leased, not owned. The apartment is leased, not owned. There are no significant personal assets in his name that I can identify in the public record. Another long silence. He does not own anything, Claudine said, and she said it not as a question but as the end of a calculation she had been running without knowing she was running it. Nothing significant that I can find in the public record, I said. And the current business, Betes, she said. The consultancy. I have told you what the public record shows, I said. I cannot speak to the internal operations. But I can tell you that the SEC examination is now more serious than a preliminary inquiry, and that the association with a barred advisor in a business that claims to arrange institutional property transactions is the kind of association that tends to attract sustained regulatory attention. He called Sorrel, she said. I am aware. He threatened him. I have heard that characterization. He is going to make it worse, she said with the specific resignation of someone who has watched a person they know very well make a particular type of mistake for the last time. That is my assessment as well, I said. She was quiet for a moment. Celeste, she said, I have retained my own attorney, not a family attorney, mine. I think that is the right decision, I said. I want you to know that I am going to cooperate with whatever process moves forward. The SEC, the family meeting, the financial disclosure. I am going to tell the truth. I appreciate that, I said. I am also going to tell the truth about the dinner table meeting, she said. It was my idea to ask you to leave. Fletcher agreed, but I pushed it. I thought that if we had the house to use as a legitimate business address and meeting space, it would give the consultancy a credibility it was not generating on its own. I used you to solve a problem that was not yours to solve. I sat with that for a moment. It was the first genuine accountability I had received from any member of the household since November, and it came from the person I would have least expected to offer it. I appreciate you telling me, I said. I am not asking for forgiveness, she said quickly. I am not doing that. I am just telling you the truth because you have spent this whole situation telling me the truth, and I think You deserve the same. After the call ended, I sat in my apartment for a long time without opening my laptop or picking up my phone. The November light was moving through the west-facing windows of my West Loop apartment, and the city was producing its Friday evening noise 8 floors below, and I thought about what it meant to be told the truth by someone who had no strategic reason to tell it. It did not change the facts. It did not change the arithmetic. But it changed something in the texture of the situation, the way that a forensic reconstruction changes when a previously silent witness decides to speak. Saturday morning arrived with a grey Pacific Chicago cold that felt entirely appropriate. I drove to Evanston. I arrived at 9:50. The house looked the same. The oak tree had lost most of its remaining leaves since my last visit. 2 weeks of November had completed the work that the first visit had begun. My mother answered the door. She looked different from 2 weeks ago. Not physically different, or not dramatically so, but something in her bearing had shifted. The managed composure was still there, because 30 years of social performance does not dissolve in a fortnight. But it was sitting differently on her, the way a coat sits differently on someone who has stopped pretending it fits. "Everyone is in the dining room," she said. The dining room table had the documents on it. This was new. In all the years I had sat at this table, it had held dinner plates and holiday displays and the performative hardware of a family maintaining the appearance of togetherness. It had never held documents because documents were the kind of thing that made the appearance difficult to maintain. My father was in his usual chair, which was not the head of the table this time, but the side a repositioning that felt deliberate. His attorney, a grey-haired man named Marcus, who I gathered from Raymond's background check, practiced primarily in estate and financial planning law, sat beside him with a legal pad. Fletcher sat across from them, his blazer replaced by a sweater that suggested a different strategic register than the previous visit. Claudine sat slightly apart from him, which I noticed, and which I suspected Fletcher had also noticed, though he was performing unawareness with limited success. My mother sat at the end of the table that had been hers. I sat at the end that had been nobody's, which was now in the quiet geometry of a table rearranged by circumstance the head. "I have prepared a financial disclosure statement," Marcus said, distributing copies of a bound document. "It covers all accounts obligations and asset positions held individually and jointly by Edward and Diane Vane. It is complete to the best of our knowledge and has been reviewed by a licensed CPA." I opened the document and began reading. I did not speak while I read. The room was quiet enough that I could hear the oak tree moving outside the dining room window. It took me 12 minutes to read the disclosure completely. When I finished, I closed the cover and set it on the table in front of me. The numbers confirmed everything my reconstruction had found, with minor variations in the precise figures that were attributable to the difference between public record data and actual account statements. My father owed $419,000 in aggregate, slightly more than my estimate. The equity line demand was confirmed at $178,000. The IRS arrangement was confirmed at $61,000 with penalties. The primary mortgage was confirmed as current, which it was because I was still making payments. I was still making payments because I had decided, in the 2 weeks since the first meeting, that stopping payments unilaterally before the situation had been formally addressed would harm my mother and potentially harm the lender in ways that had nothing to do with what my family had done to me. The payments were a form of professional integrity. I could separate my personal situation from the financial architecture I was responsible for, maintaining the way a forensic accountant maintains the integrity of a reconstruction even when the subject of the reconstruction is someone they despise. I did not despise my family. That was the part that was hardest to articulate when I thought about it clearly. I was not angry at them in the burning, consuming way. I was done with them, which is different and in many ways more permanent. Anger implies investment. What I felt was closer to the specific finalized clarity of a case file that has been completed, certified, and archived. The disclosure is accurate. I said within the margin of variance I would expect between public record reconstruction and actual account data. Thank you for the transparency. I looked at Marcus. I have one question about the equity line. The demand notice specified a 60-day window. Where are we in that timeline? 31 days in, Marcus said. 29 days remaining. 29 days to find $178,000 that did not exist. What is your recommendation regarding the equity line demand? I asked. Marcus looked at my father, who nodded slightly. Our recommendation is a negotiated extension with the lender. We believe we can make a case for a 30 to 60-day extension based on the active family financial restructuring process. It would not be a permanent solution, but it would create breathing room. For what purpose? I asked. What is the longer-term plan? Marcus cleared his throat. Edward has been advised that a sale of the property is the most realistic path to satisfying the combined obligations. The estimated net proceeds after satisfying the primary mortgage and the equity line would leave a surplus of approximately $90,000 to $120,000, depending on the final sale price. From that surplus, the judgment and the IRS arrangement could be substantially addressed. Substantially, I said. Not fully. The combined judgment and IRS obligation totals approximately $155,000, Marcus confirmed. The projected surplus would not fully satisfy both. A payment plan arrangement would be required for the remainder. I looked at the table for a moment. The sale proceeds, I said. They assume the equity line is serviced from the proceeds. They also assume the primary mortgage is being serviced until the sale closes, which requires continued monthly payments of $4,200. Yes, Marcus said. Who is making those payments? A brief silence. Currently, Marcus said carefully, the arrangement that has been in place continues, but we recognize that the arrangement requires Celeste's consent to continue, and that the consent should be formalized under the revised understanding of the equity interest. I looked at my father. What this means, I said, directing my words to him rather than to Marcus, because Marcus was not the person who needed to hear this directly, is that you need me to keep paying the mortgage for however long it takes to sell the house, which at current market conditions in Evanston would likely be 4 to 6 months. And the money I advanced during that period would be added to the secured interest already documented in the lien registration, which means it comes back to me with priority from the sale proceeds. My father looked at me. Yes, he said. That is what we are asking. You are asking me to finance the sale of a property that I was asked to leave, I said. In exchange for the return of money I have already contributed, plus the additional contributions I would make during the sale period. I understand how that sounds, my father said. I want to make sure you understand clearly, I said. Because the last time I was asked to contribute to this household, the framing was that I was a responsible adult paying my share. This time, I want the framing to be accurate. I would be financing the resolution of a financial crisis created by decisions I was not involved in making in exchange for the return of what is legally my money. Yes, my father said again. His voice was very quiet. I also want to be clear. I said that I am not making this decision on the basis of family loyalty. I am making it if I make it on the basis of the mathematics. The property sells for more if it is not in default, and the mortgage has been consistently serviced. My recovery of my secured interest is more certain if the property sells cleanly. The practical interests align. Marcus nodded. That is an accurate characterization of the financial logic. I will need the revised agreement to reflect the additional contributions as secured equity to be registered with the same priority as the existing lien, I said. I will need monthly accounting of the sale process from your office, Marcus, to my attorney Raymond. I will need the right to approve the listing agent and the listing price. And I will need the authority to accelerate the process if the sale timeline extends beyond 6 months. Marcus made notes. I had one more thing. I set my portfolio on the table and opened it to the final section. There is also the matter of Fletcher's situation, I said. Fletcher, who had been very still throughout the financial discussion in the way that people are still when they are listening for the specific moment when their name will be mentioned, looked at me. "The SEC examination is proceeding," I said. "I do not know the outcome and I cannot predict it, but I want to be on record in this meeting that the contact I had with the regional office was made in my professional capacity and was motivated by a genuine regulatory concern, not by a desire to harm you personally." "It caused harm personally," Fletcher said. "I know," I said, "and I want to say something to you that I want the room to hear." I paused. "I did not cause the Sorrel situation. I did not cause the Chapter 7. I did not cause the pattern of behaviour that created the regulatory concern. I observed it, and I reported it, which is what my professional obligations require. If I had observed the same pattern in a client matter, I would have done the same thing. The fact that you are my brother did not change the professional obligation, but it made the decision harder than any professional decision I have ever made." Fletcher stared at the table. "I also want to say," I continued, "that Claudine had an independent conversation with me last night in which she told me the truth about the dinner table meeting and accepted responsibility for her role in it. I want the room to know that I heard that and that it matters to me." Claudine looked at me. Fletcher looked at Claudine. My mother looked at the window. "I think," my father said quietly from his position at the side of the table, "that we owe Celeste a significant apology, not as a transaction, not as a step in a process, just as the truth." He looked at my mother. "We treated her as a resource and not as a person, and we have been doing it for a long time." My mother turned from the window. She looked at me with the expression I had seen beginning to form at the door 2 weeks ago. The one that had been working its way from the periphery of her awareness toward the center of it, in the intervening time. "I am sorry, Celeste," she said. "I am genuinely sorry, not for the situation, for the years before the situation." I looked at her. I thought about the $4,200 a month for 48 months. I thought about the dining table meeting and the cashmere shawl and the word contribution and the word temporary. I thought about 31 years of being the daughter who sat at a computer and looked at numbers while her brother was the one who understood the real world. "I hear you," I said. "I am not ready to discuss what that means beyond this meeting. But I hear you." Marcus cleared his throat gently. "Shall we move on to the documentation?" We spent another 90 minutes formalizing the revised agreement. By the time Marcus gathered his papers and the meeting concluded, the November light had moved past noon, and the oak tree outside the dining room window had gone from grey to the specific pale gold of early afternoon. I drove back to the city alone. What followed was not dramatic. Real financial restructuring rarely is. It is a process of paperwork and patience and the slow grinding resolution of obligations that were created in an atmosphere of optimism and are being resolved in an atmosphere of accountability. The listing agreement for the Evanston house was signed 5 weeks after the disclosure meeting. I approved the listing agent, a woman named Sandra, who Raymond had recommended and who had a track record of moving comparable properties in Evanston in under 90 days, and the listing price, which was set at $1.15 million, based on a comparative market analysis I reviewed and found methodologically sound. My father and mother began the process of finding alternative housing. This was difficult for my mother in a way that I had anticipated and in a way that I had not. The anticipated difficulty was financial. They had no meaningful down payment and a significantly damaged credit profile, which meant that purchasing was not an option, and that rental required either a guarantor or a prepaid security arrangement. The unanticipated difficulty was social. The Evanston house was the physical anchor of an identity my mother had maintained for 22 years, and the process of leaving it was for her the process of acknowledging that the identity had been constructed on a foundation that was not what she had believed it to be. She called me twice a week during the listing period. The calls were different from the calls of the first months. They were less managed, less performed, and they contained a kind of honesty that I had not previously experienced from her in any sustained form. She told me things about her marriage that I had not known about the years when she had suspected the financial situation was worse than she was being told, and had chosen not to pursue the knowledge because the knowledge would have required action she was not prepared to take. She told me about the specific fear that had sustained her avoidance, not financial fear, but the social fear of a woman whose entire standing in her community was structured around the appearance of stability. I listened to all of it without judgment and without the clinical detachment I brought to professional matters. My mother was not a client. She was a woman I had known my entire life, and she was telling me the truth for what felt like the first time. I think she said during one of these calls in the 6th week of the listing period, that I have spent my whole adult life being managed by the people around me. Your father managed the financial information. Fletcher managed my understanding of his businesses. And I managed you, because you were the only person in the household who was actually generating something, and I was afraid that if I acknowledged that clearly, it would require me to acknowledge everything else. Yes, I said. I think that is accurate. That is a terrible thing to do to your child, she said. Yes, I said again. It is. I do not know how to make it right, she said. You are making it right now, I said. By saying it. The house sold in 67 days. The sale price was $1.08 million, slightly below the listing price, which in the current market was a reasonable outcome. After satisfying the primary mortgage balance of $640,000 and the equity line demand of $178,000, the gross proceeds were $262,000. From that amount, my secured interest was satisfied first. The 48 months of original mortgage payments, plus the 6 months of continued payments I had made during the listing period, totaled $269,600. Slightly more than the gross proceeds. Which meant that after my secured interest was satisfied, there was nothing left. My father and mother received from the sale of the house they had lived in for 22 years a net distribution of $0. I want to be precise about this because the precision matters. I did not take their money. I recovered my own money which they had used to maintain a property I had been paying for and then been asked to vacate. The arithmetic was simple and it was fair in the only sense that matters in financial disputes, which is that it reflected the actual contribution of each party. Marcus called me the day the distribution was confirmed. I want you to know, he said, that Edward and Diane understand the outcome and have not contested it. They accept that it is consistent with the documented agreement. I know, I said. My father called me last night. He told me he was going to call you. He was generous in how he spoke, I said. He did not make me feel that I had taken anything. You did not take anything, Marcus said. You recovered a debt. I know, I said. But there is a difference between knowing that and feeling the weight of it. I am aware of the difference. Marcus was quiet for a moment. For what it is worth in 40 years of practice, I have rarely seen a financial restructuring of this complexity handled with this level of discipline. You protected your position without escalating unnecessarily. You gave the process time to work. You did not use the leverage you had beyond what was required. I did not need to use more than what was required, I said. The math was sufficient. Fletcher's situation resolved itself over the following 3 months in a way that followed the pattern I had described to Claudine in our Friday evening phone call with reasonable fidelity. The SEC examination concluded that the business relationship between Vane Property Group and Philip Sorrell constituted a de facto continuation of Sorrell's investment advisory activities through an unlicensed intermediary in violation of his bar order. Because Fletcher had not been aware of the specific regulatory provisions at the time the arrangement was entered into, or so his attorney argued, and the examination team found the arguments sufficiently plausible, he was not charged with securities fraud. He was, however, issued a formal cease and desist order requiring the immediate termination of all business activities with Sorrell and the wind-down of Vane Property Group's existing client engagements. Vane Property Group LLC was voluntarily dissolved 2 weeks after the cease and desist order. The phone call between Fletcher and Sorrell, the one that Sorrell had characterized as threatening, was ultimately not pursued as a separate matter. The examiner concluded that it did not rise to the level of obstruction, and that Sorrel had not been materially harmed by it. This was a better outcome than Fletcher deserved in my professional opinion, but outcomes in regulatory matters rarely correspond precisely to desert. Claudine's attorney had filed for legal separation the week after the family disclosure meeting. By the time the Evanston sale closed, the separation had become a divorce proceeding. The settlement was not complicated because there were not many assets to divide. The lease on the River North apartment was in Fletcher's name and could not be easily assigned. The car was leased. There was a joint bank account with a balance that was by the time the divorce was filed significantly smaller than it had been at the start of the year. Claudine took the joint account balance, her personal property, and a modest divorce attorney fee that she paid from the account before it was divided. She moved into a smaller apartment in Lincoln Park and resumed the interior design career she had apparently practiced before marrying Fletcher, which I learned from Raymond, who learned it from a mutual contact in the legal community. She sent me a text message on the day the divorce was finalized. It said, "Thank you for the phone call and for the Friday evening conversation. I know those were not easy for you either." I responded, "Good luck with the practice. You are good at understanding spaces." She sent back a single emoji, the small one that looks like a wry acknowledgement, and that was the last communication we had. Fletcher himself, the brother who had leaned against the window at the dining table with his arms crossed, and his smirk and the keys to his leased Porsche spinning around his finger, was by the time the calendar year concluded living in a studio apartment in Rogers Park, working as a sales associate for a commercial real estate brokerage, where he was, as far as I could determine from the public record, performing actual transactional work under supervision for the first time in his professional life. Whether he was doing it well or poorly, I did not know and did not attempt to find out. He did not contact me. I did not contact him. My parents found a rental apartment in the western suburbs, a two-bedroom in a building near a community with which my mother had no prior social associations, which was, I suspected, partly a practical choice and partly a deliberate one. Starting over is easier in certain ways when you are not doing it in front of an audience that knew you before. My father took a part-time position with a small insurance agency in the area doing the work he had done 30 years ago before he had decided that the work was beneath him. My mother took a part-time administrative position at a local non-profit, which she described to me in one of her Wednesday calls with a mixture of self-deprecation and something that sounded very much like relief. "I had forgotten," she said, "what it feels like to do something that actually needs to be done." "That is a good thing to remember," I said. They were not comfortable. They were not in the life they had maintained the appearance of living for 20 years. But they were living in the truth of their situation for the first time in a very long time. And there is a specific kind of stability that comes from that, the stability of not having to manage the gap between what is real and what you are performing. My father called me every 2 or 3 weeks. The calls were not easy, and they were not the calls of a father and daughter who had resolved everything and arrived at a new harmony. They were the calls of two people who had been in a complicated and often dishonest relationship for 3 decades, and were cautiously and incrementally trying to understand what an honest one might look like. I did not rush it. Rushing is not something I am inclined to do in the absence of a professional timeline. I let the calls be what they were, which was imperfect and sometimes uncomfortable, and occasionally genuinely warm in a way that surprised me, and I allowed for the possibility that imperfect and genuine was better than polished and false, which it had always been. Raymond's birthday fell in March, and I took him to dinner at a restaurant in the West Loop that he had been trying to get a reservation at since October. We sat at a corner table with good wine and a view of the street, and he told me about a new matter he was taking on a complex estate dispute that had been developing for 3 years, and I told him about a new forensic engagement I had agreed to start in the spring, a securities fraud case for a plaintiff class that had retained the firm for which I now operated as a lead consultant. Toward the end of the dinner, Raymond set down his glass and looked at me with the expression he used when he was going to say something that was not professionally framed. "Can I ask you something?" he said. "You have been asking me things for 9 years," I said. "You do not need permission." "The sale proceeds, he said. "You could have left your parents with something. The calculation was that close. If you had structured the secured interest differently or applied a discount to the older payments—" "I know," I said. "You chose not to." "Yes." "Why—" I looked at the street outside the window for a moment. The March cold was doing what Chicago cold does, persisting well past the point of seasonal logic, the city's specific argument that winter ends when it decides and not before. Because discounting the older payments would have been a decision made on the basis of feeling, I said, not on the basis of the documented agreement. The documented agreement said the payments constituted a secured equity interest. All of them. Discounting some of them would have been me inserting a mercy calculation into a factual record, and I am not the person who puts mercy into factual records. "You are saying the outcome was not a choice," Raymond said. "It was just arithmetic." "I am saying the arithmetic was what it was," I said. "I followed it where it went. And if it had gone somewhere different, then I would have followed it somewhere different." Raymond looked at me for a moment. "You know," he said, "most people in your situation would have either done nothing or done something dramatic. Sued, threatened, publicized. You did neither. Neither of those produces the outcome I wanted," I said. "What outcome did you want?" I thought about this. It was the first time anyone had asked me the question directly, and I had the sense that the honest answer was one I had not quite articulated even to myself. "I wanted the picture to be accurate," I said finally. "That is all. I wanted the financial reality of my family to stop being managed and obscured and performed and start being visible. Not as a punishment, not as a demonstration, as a matter of record." I paused. "I spent 9 years making financial realities visible for clients who were being defrauded or deceived. The only situation in which I had been willing to look away from a distorted financial picture was the one that was closest to me. I stopped being willing to look away. That is all it was." Raymond was quiet for a moment. Then he picked up his wine glass. "Happy birthday to me," he said. "I get to know you." 6 months after the sale of the Evanston house, I received a letter. It was handwritten, which was unusual enough in the current era that I held it for a moment before opening it, registering the weight of the paper and the care of the handwriting on the envelope. The return address was my parents' apartment in the western suburbs. The letter was from my mother. It was 3 pages long. I will not reproduce it in detail because it was addressed to me, and it belongs to me in the way that private correspondence belongs to the person it was written for, not to anyone reading this account. But I will say that it contained the most complete account of her understanding of what she had done and what she had allowed to happen, and why she had allowed it, that I had received from any member of my family in my lifetime. She wrote about the years when she had known something was wrong and had chosen not to know it clearly. She wrote about the specific mechanism by which she had managed the gap between what was real and what she performed, the social commitments, the country club, the managed appearances that required her to never fully look at what was funding them. She wrote about what it had meant to raise a daughter with a capacity for precision and then spend that daughter's adult life managing her as a financial resource rather than acknowledging the precision. She wrote, "I think I was afraid of you, not of your anger, of your clarity. When you see things clearly, the things you see become harder to look away from. I found it easier to keep you at a distance where I could not hear the specific way you described what was real." I sat with that sentence for a long time. Then I wrote back. I took 3 days to write the letter. I did not draft it the way I drafted professional documents, not in a single, organized session, not from an outline. I wrote it the way I write when the structure has to come from somewhere other than methodology. In pieces. Setting it down and coming back to it. Saying things and then revising them not for precision, but for honesty, which is a different kind of revision. I told her that I understood what she had described, not because I excused it, but because I had spent 9 years watching people manage the gap between what was real and what they performed. And I had developed a professional understanding of how much energy that management required and how completely it consumed the person doing it. I told her that the clarity she had described being afraid of was not a weapon I had deliberately chosen. It was simply the way I perceived things, and I had spent a significant portion of my adult life learning to live with the particular loneliness of perceiving things clearly in a family that had organized itself around not perceiving them. I told her that I did not know yet what a repaired relationship between us would look like, but that I was willing to find out in the way I was willing to find out anything incrementally with documentation, with patience for the process. I told her that she had, in the last 6 months, done something I had not expected and had not asked for, which was to tell the truth. Repeatedly, without being asked, without strategic benefit in circumstances where telling the truth made her look worse rather than better. I told her that this was not nothing, that in my professional life and in my personal life, the willingness to tell the truth when it is costly was the most important thing a person could demonstrate, and that she had demonstrated it. I signed the letter and mailed it from the post office near my apartment on a Thursday morning in April, the first morning that the Chicago cold had genuinely and convincingly released its grip on the city. The Apex Innovations Center analogy from the Olivia story, the one about tearing down a corrupt structure to build something new on its foundation, is a compelling image, and I understand its appeal. It is clean, and it is complete, and it has the specific satisfying quality of a narrative that resolves itself into a monument. My story does not do that. There is no new building on the Evanston lot. The property sold to a young family who were by all accounts planning to renovate the kitchen, which strikes me as a reasonable thing to do with a kitchen that has already been renovated once, on borrowed money. What I built is less visible and less photogenic. I built a practice. I took the federal engagement fee and the 4 months of salary I had been banking while living at reduced overhead, and I used them to establish my own forensic accounting and fraud examination firm, which I named, with the deliberate plainness I prefer in professional contexts, Vane Forensic Consulting. The name is mine. The work is mine. The terms are mine. I work on the cases I choose to work on, which are the ones where the financial picture has been deliberately distorted in ways that cause real harm to people who trusted a system that was being manipulated. I work with Raymond's firm on related legal matters, and with 3 other attorneys I have developed relationships with over the years. I take on approximately 12 to 15 engagements per year, which is enough to support the practice, and the practice's staff, which consists of 2 junior examiners and a case coordinator who manages the administrative infrastructure with a competence I find deeply satisfying. I am not wealthy in the way that the word wealthy is used in the kind of story I have been telling. I am financially independent, which is a different and more useful thing. I have a secured position that does not depend on anyone else's decision to keep me or discard me, which was the specific vulnerability that the dinner table meeting exploited, and which I have structured my professional life to never be subject to again. The last thing I want to say is about the numbers. People who work in forensic accounting hear a version of the same observation frequently from clients and colleagues and family members and strangers at social events who learn what I do and want to engage with it at the level of concept before they are willing to engage with it at the level of detail. The observation usually takes a form something like, numbers are just numbers. People are what matter. I understand the intention behind the observation, and I do not dispute the importance of people. But the observation contains a misunderstanding that I have spent 9 years trying to correct, not combatively, but by demonstration. Numbers are not just numbers. Numbers are the record of decisions. Every transaction in a financial history is the trace of a choice: what to acquire, what to discard, what to prioritize, what to conceal. A financial reconstruction is not an exercise in abstraction. It is the recovery of a human story that someone decided to obscure and the act of making it visible again. When I reconstructed my family's financial history, I was not doing arithmetic. I was recovering decisions. My father's decision to draw down the equity line rather than acknowledge the scale of his debt to his wife. My mother's decision to not ask the questions whose answers would have required her to change. Fletcher's decision to describe investor losses as a market shift rather than a management failure. Claudine's decision to marry a financial architecture she had not examined because examining it would have been uncomfortable. And my own decision for 4 years to keep paying a mortgage on a house I was being treated as a guest in because paying it was easier than the alternative, which was to look clearly at what my payment was financing and what it was asking me to accept in return. The numbers told me the truth about all of those decisions. That is what numbers do when you know how to read them. They do not judge. They do not perform. They simply accumulate in the precise and patient way of a record that is waiting for the person who is willing to look at it directly. I looked at it directly. That is the whole story. One afternoon in early June, I was working at my desk when my phone showed a text from a number I did not have saved. "This is Claudine. I wanted to let you know I opened the practice last week. Interior design. I have 3 clients and enough work to keep the lights on. I thought you might want to know that." I looked at the message for a moment. "Good," I wrote back. "Keep going." She sent the wry emoji again. And then, after a moment, a second message. "I have been thinking about what you said, about the numbers being decisions. I look at spaces differently now. Every room is someone's decisions about what matters. I think you were right that it is the same thing." I set the phone down and looked at the window. Outside Chicago in June was doing the thing it does when it has finally relented, turning unreasonably beautiful the lake visible from certain angles between the buildings, the city wearing its brief summer self with the particular energy of something that knows it will not last long and is making the most of it. I picked up the phone. It is the same thing I wrote. Architecture and accounting. Both are just reading the record of what people decided. Then I set the phone down, opened the file for my current engagement, and went back to work. Celeste's story is at its core about the specific courage required to see clearly in a family system organized around not seeing. Every toxic family unit has a designated keeper of the real information, the person whose perceptiveness is simultaneously the most valuable asset in the household and the most threatening. Celeste was that person for the Vane family. She saw the financial picture clearly for years, and for years she chose not to act on what she saw, because acting on it would have meant destabilizing a system she was, despite everything still hoping to belong to. The dinner table meeting was not the beginning of Celeste's power. It was the beginning of Celeste's willingness to use it. The power had always been there in the form of 3 years of documented observation, in the form of professional skills that her family had systematically undervalued, in the form of a financial contribution that had been framed as a responsibility rather than a leverage point. What changed was not the arithmetic. The arithmetic had always been what it was. What changed was Celeste's decision to stop lending the arithmetic to a household that was using it to fund a fiction. The most important lesson in this story is not the one about financial literacy or professional competence, though both are present. It is the one about the relationship between clarity and belonging. Celeste had been told implicitly and explicitly for most of her life that her clarity was an obstacle to belonging, that the way she saw things was incompatible with the comfortable opacity that her family required to function. She had been asked in 1,000 small and large ways to manage her clarity rather than exercise it to contribute her financial capability while suppressing the perceptiveness that made it possible. The dinner table meeting was the final instance of that request, and for the first time she declined. The outcome was not comfortable. The outcome was honest. And in the long run, honest is the only thing that holds. If you have ever had to choose between a comfortable fiction and a costly truth, you know what Celeste knew in that hotel room with her bank balance on the screen, and her family's financial reality finally visible in its complete dimensions. The truth costs less in the end. It always does. Subscribe, share this story with someone who needs it, And leave a comment if you have ever had to stop subsidising a story that was not true.